There's a way to buy a house without qualifying for a new loan, without a bank approving you, and without the seller paying off their existing mortgage. It's called a subject to deal, and it gets thrown around online like it's a magic trick. It's not a trick. It's a real legal strategy with real risk sitting underneath it that most people selling the idea don't explain clearly. I want to walk through exactly how it works and exactly where it can go wrong. Here's the core mechanic. When you buy a property subject to the existing mortgage, the seller's loan stays in place, still in the seller's name, still on the seller's credit. It's important to distinguish this from a wraparound mortgage or an AITD. In a subject to, you're not creating a new note. You're simply taking over the payments on the existing one with the original terms intact. You take ownership of the property through a deed, but you do not assume the loan or get the lender's approval to take it over. This means your personal debt to income remains untouched. You simply start making the payments on their behalf, and you own the property and control it going forward. It's the ultimate low barrier entry for scaling a portfolio. The seller walks away from a property they can no longer afford or don't want, often without having to come up with cash to pay off the loan through a traditional sale. Now here's the risk nobody skips past fast enough. Almost every mortgage has what's called a due on sale clause. It gives the lender the right to call the entire loan balance due immediately if the property is transferred without their approval. This is the primary risk factor. Transferring the deed while the loan stays in the seller's name technically triggers that clause. The bank now has the legal right to demand their money in full. In practice, lenders don't call loans due on sale very often, especially if payments are being made on time, because banks don't want to foreclose on a performing loan. However, keep an eye on bank mergers. When a loan is sold or a new servicer takes over, they audit the file. This is when many due on sale issues actually surface during the administrative handoff. But not often is not the same as never. And if a lender does call the loan, you either have to refinance the property fast or you risk losing it to foreclosure. You need a backup plan. Insurance is the next landmine. The existing homeowner's policy is in the seller's name, tied to the seller as the insured party. If you don't address this, you could end up with a property where nobody has valid coverage in your name when a claim happens. The insurer can deny a payout if the named insured doesn't own the home. If the bank notices the insurance has changed or the name doesn't match, they might force place their own policy. This is incredibly expensive and offers you zero liability protection. The workaround most investors use is a binder policy or working with an insurance agent who specializes in subject to transactions to name you as an additional insured or the loss payee. Skip this step, and a single fire or storm claim can turn into a legal nightmare over who actually gets paid. In Florida, wind and storm claims are a matter of when, not if. Here's why the land trust matters and why experienced subject to investors almost never take title in their own name directly. Putting the property into a land trust adds a layer of privacy and can help avoid tripping the due on sale clause under a specific federal law called the Garn-St. Germain Act. Under this act, lenders generally cannot accelerate a loan for a transfer into a revocable trust where the borrower remains a beneficiary and the transfer doesn't relate to the right of occupancy. This is not a loophole that guarantees the lender will never call the loan. It's a structure that reduces the likelihood and gives you more legal footing if they try to accelerate. You'll also need a letter of authorization from the seller. This allows you to talk to the bank, get payoff statements, and handle escrow issues directly without the seller having to intervene every month. Now let's talk about why a seller would actually do this deal, because if you don't understand their motivation, you'll misprice the offer. Sellers who go subject to are usually facing one of a few situations. They're behind on payments and headed toward foreclosure. They need to stop the auction. They've inherited a property with a mortgage they don't want, or they're relocating and simply can't afford 2 mortgage payments at once, or their credit is already damaged enough that a short sale or traditional sale doesn't solve their real problem, which is getting out from under the debt without further damage. I cannot emphasize this enough. Give the seller a full disclosure document. They must understand that the loan stays in their name and that if you stop paying, their credit is on the line. Transparency prevents lawsuits. Subject to works because it stops the bleeding for them immediately, often within days, without them paying closing costs or a realtor commission. Here's how the numbers typically work for you as the buyer. You're not paying the seller a large sum up front in most cases. Instead, you're taking over a loan, often at an interest rate well below current market rates if it originated a few years ago. That rate spread is where your profit lives, and you might pay the seller a smaller cash amount for their equity, or in some cases nothing if they have little to no equity and just need to be done with the property. Never take over a loan just because the terms sound good on paper without confirming the numbers work with a real rent comp or real resale comp. A low rate on a bad property is still a bad deal. Be prepared for escrow shortages. If property taxes or insurance premiums go up, the monthly payment will jump. In Florida, insurance increases can turn a cash-flowing subject to into a monthly liability overnight. Let's talk about how payments actually get handled, because just send the seller the mortgage payment is a bad plan in practice. Most experienced subject to investors use a third-party loan servicing company to collect the payment from the buyer and send it directly to the lender each month. This creates a paper trail proving the loan is being paid on time and protects the seller from a buyer who stops paying without any warning. It keeps everything professional. Also, decide up front who gets the escrow refund checks if the loan is ever paid off or if there's an overage. Usually those checks are still cut in the seller's name, so you need a plan to handle that money. The seller needs protection too, and too many subject to deals only think about protecting the buyer. A well-structured deal includes a separate note or performance mortgage back to the seller, giving them a legal path to reclaim the property through foreclosure if you stop making payments. Any investor doing volume in this space should want their sellers protected, because a seller who feels burned is a seller who calls an attorney and potentially ruins your reputation in the market. Stay in touch with your sellers. If they get mail for the property or tax documents, you need a smooth way to get that information. Maintaining a good relationship is part of the operational risk management. Before you close anything, get title work done. Confirm there are no other liens, judgments, or second mortgages you don't know about. In Florida, look out for unrecorded utility liens or code enforcement fines. These don't show up on a casual search but will stay with the property after you take the deed. If the seller inherited the property, ensure probate was handled correctly. A subject to on a house where title hasn't fully cleared probate is a recipe for a future quiet title lawsuit. Always get an HOA estoppel. If the seller is behind on mortgage payments, they are likely behind on HOA dues as well. Those dues can carry the right of foreclosure and take precedence over your interest. Anything else attached to the title becomes your problem the moment you take the deed. Distress often comes with more debt than just the first mortgage. Be thorough. Consider your exit strategy. A common one for subject to is a lease option to a tenant buyer. You collect a non-refundable option fee and a monthly rent spread while the underlying loan is paid down. This sandwich lease requires you to be a pro at property management. You are responsible to the seller and the bank, while the tenant is responsible to you. You are the middleman in the risk chain. Another exit is the fix and flip. You take over the payments during the renovation phase and pay off the loan when you sell the property. This is a great way to reduce your holding costs during a rehab. So here's your actionable takeaway. If you're going to do a subject to deal, use an attorney or a title company experienced in these transactions. Don't use a generic closing agent. Structure the deed transfer and set up the insurance and trust correctly. Run full title work before you take the deed. Don't take shortcuts. And go in with a plan for what happens if the lender does call the loan due, whether that's refinancing capacity, a sale exit, or having enough cash reserves to pay the balance. In a fast-moving market like Tampa, speed is an advantage, but only if your mechanics are sound. From Clearwater to Brandon, investors are using these deals to build massive wealth the right way. This strategy works, and it works well when the mechanics are handled correctly. It becomes a disaster specifically when people skip the insurance, skip the title search, or skip planning. Subject to is the bridge that lets you scale past the 10-loan limit of conventional financing. Master these details and you'll have a competitive edge most investors never achieve. I'm Tony Damiano from eXp Realty. If you're ready to navigate subject to deals with a pro who knows the Florida market, reach out to me at 813-345-7487 or visit tonino.damiano@exprelty.com. Let's make your next deal happen.